Hello everybody, welcome to tonight's webinar on government grants. We're going to be working through IAS 20 and ASPE section 3800 related to government assistance. I just wanted to check in to see if my sound is okay, if you can let me know. Please type in the chat. And the copyright of the standards belong to CPA Canada and other provincial CPA bodies from the CPA Canada Handbook. The interpretations below are my own, personal opinion, and all rights are reserved. The opinions below are my own and are not to be relied upon. The information provided below is for illustrative purposes only and is not advice or guidance. Learn Formula is not affiliated with or related to CPA bodies. Learn Formula's activities have not been reviewed or approved or endorsed by those CPA bodies. Okay, so it seems like my sound is good. Thank you. Tonight I'm your session or webinar leader, and just to share a little bit about my background, I'm a mentor here at Prep Formula. I do work with quite a few mentees, which is quite a lot of fun to chat and learn some things from you guys. I'm a independent contractor for CPA Canada, teaching Core 1, PM, Assurance, Capstone 2, and I'm also a professional marker for the CPA. And I've also marked at the National Marking Center. Just to kind of talk a little bit to make sure that, now is about March. And for those of you who are working on whether you are working on your electives or the CFE, it's sort of closely coming up, right? The exams for the electives are coming up by the end of March, early April, like the first week of April. And the CFE, Capstone 2 begins about April. And one of the big things is, don't wait until then to actually start. I think most people need quite a bit of time in terms of leading up, and that's where your mentor should come in to help you with that. You definitely should reach out to your mentor, or your mentor would have reached out to you. And this process is pretty challenging, right? And you don't have to go through it alone. Your mentor is here to help you. There's a lot of resources and information that's out there, and your mentor, with that experience that they have, should be able to glue that information for you and help you, guide you in terms of that, right? Like, they have a lot of experience. They've gone through these sessions. They've learned a lot for a long period of time. And a lot of what you are getting that access or exposure to is to these mentors who can help you, give you that edge to help your exams, right? And that's really what I try to do with my mentees. Before we begin, I want to make sure that you get the CFE 2020 study guide, email support@prepformula.com. What I'm going to be using and working with tonight is through excerpts of that study guide, just to make sure that you know how to use it. So make sure you do email them for it, and that's where you will get it. And so just to kind of open it up to show you what that looks like. So you will see it. Oh, sorry guys. Sorry guys, my computer is kind of lagging a little bit. Just bear with me 1 second while it kind of clears all the processing that's happening. Okay, so you should be able to see the guide that's here. And one part of the guide I want to make sure that you point to and see is this financial reporting competency, which you can find through going into financial reporting competency. And then make sure you do read through what this competency is, how you go through with your analysis, and most importantly, learning how to pull the relevant criterion, because you do get this during the exam. So the handbook, which you do get in the exam, but if you don't know how to solve the problem, or if you've never had experience addressing the problem, using the handbook for the first time to go through it is going to be tough. So you want to make sure you have that awareness and where specific criterion are, and have that experience of doing it. This is not something you want to wing in the actual exam, okay? Like, you want to know how to do this, and you have some comfortable experience doing it, because pretty certain you will be dealing with some AOs that you've never really practiced on, and you want to have that ability to go through the handbook and pull that criterion out, okay? And so here I've kind of written something down to teach you how the handbook is formatted and shown. And then to go into the handbook, tonight we're working through ASPE and IFRS. So if we go into IFRS, we're going into government assistance. So we're going into government assistance, IAS 20, okay? And the format is laid out a little bit different, but it pretty much follows a very structured format. Be very mindful of, you see capitalized and bolded, and then the bolded, uncapitalized, and then so that's pretty much in the contents, how it's organized. And as you go down, specific for IFRS, you will see that there are bolded items here. This is what you're going to generally use in your criterion. And then the areas related to the unformatted down here is additional explanations to help you understand the bolded section. So that's why if you kind of get some experience and exposure to know how it's used, this is going to help you. So this is the section we're going to use tonight. And then if I go into ASPE, okay, so 3800 government assistance. So the formatting is a little bit different, but it's generally the same approach where you have the bolded and then you have the unbolded here. So if we go down for ASPE, what we're looking for is the italicized text, okay? So the headings with the italicized text. So if there's a government assistance related to capital expenditures, here is the criterion that you need, or guidance you need to apply when it comes to case writing. So this is where you can find it. If it's related to expenses, you could just need this paragraph 17 here. So just to try to make your job easier and efficient, just by able to find, go through the necessary noise and see what's really relevant, okay? So that's the handbook that we're going to use, and a lot of the study guide that I just shared with you is there. And just as a quick thing, the concepts here, to be very honest with you, with government assistance, it's actually very simple and straightforward. But if the concepts are unclear, do watch it during live. Just try to make sure you revisit those areas during the recording, like write down what the time stamp is for yourself, so that when it comes to areas that you're working on, you can go back and jump into it. One of the things I typically like about videos is to make sure that I write down those timestamps so that I know and what the timestamp was talking about, so I know where I can jump to and refer to, just to get that demonstration, okay? So what is government assistance? Really, I want to break it down into two things. So the first thing is, what is government assistance? It's when you get a grant from the government. Certain activities the government helps fund, right? You guys can hear a lot of the news and everything that talks about, let's say in the oil industry, government funds a lot of the oil industry. Maybe they're starting to fund some solar or alternative energies. And, there's a lot of certain types of businesses they will fund and help. Let's say, for example, small businesses, whether you are hiring more locally, creating jobs, so they will provide that type of assistance. And so when it comes to creating certain, providing that assistance, it is essentially income for you, but it depends how it's being used, okay? So the first thing is to recognize the category to that government assistance. Is it being applied to income, or is it applied to assets? Before you get the grant, you've got to go through a pretty comprehensive application process. And that application process will describe how you need to use it. And this is really important, especially when you're going through the cases. They would likely give you that type of criterion, how the grant must be used, what criterion you need to meet, whether it be covenants, revenue figures, requirements like making sure you are hiring people within your city or your town, depending on how the grant is structured. But anyway, so there's the criterion that they would have. And based on that, and then they will tell you how it's funded. So usually it's going to fall into income or assets. And if it's income, the way I want you to think about it is you're just going to record it. You can choose to record it separately as other income, or you can net it against that related expense. So it depends which, obviously this is where the discussion in your analysis should highlight that there's two options, and you present those two options, and then you would help recommend which one best fits. Okay. The next one is, if it's related to assets, the way you would record it is you would create a deferred income liability and amortize. So this is one option, to amortize with the depreciation that you are using over those fixed assets. So if you have an income of 100,000 and you have a fixed equipment that's 100,000 amortized over 10 years, each of those, so that's going to be 10,000 expense, 10,000 income, that's going to be amortized over the period. Okay. Alternatively, you could deduct it against the asset's carrying amount. So maybe the timing of when you get the grant is not the same as when you first acquired the asset, then that is different too. Okay, so I mean that's why it's carrying amount, not at the initial acquisition of the fixed asset. So just recognize the rules are relatively simple. Is it on the P&L or is it on the balance sheet? And once you kind of figure that out, you actually get an option of choice when it comes to how it's being applied, either all at once, or you net it again. If it's on income, you net it as expense, or you kind of bring it in slowly. Okay, so here's the recognition criterion. Okay, measurement is relatively straightforward. Measurement is just strictly how much you're going to get. Okay, but recognition, there's two criterion that need to be met. The entity will comply with the conditions of the grant. This is very case specific. You will be given case criterion, and you would analyze it against that with case facts whether or not the criterion are given. Okay, or whether or not they're making or making or meeting that criterion. So those are the conditions of the grant. So if you're used to solving financial reporting issues, let's say intangible assets with 6 reasons for the technical development, you're working through those criterion, right? This is no different, except the conditions will actually be given in the case, usually as an exhibit, and then you're working with the case facts to try to apply it. Now, once you are working through the compliance of those conditions, you have to know when that grant is going to be received. And that's usually broken down into these 3 steps. Okay, so the 3 steps are: the grant is received prior to the conditions being met. So irrespective of you not meeting those conditions, they're giving you the money in advance, but you're going to recognize it initially as a liability until conditions are met. Okay, sometimes there could be clawback. So if you are given a grant, let's say 100,000, and so you would need to record that as debit cash, credit, deferred liability, and then the criterion for you to be able to apply or use that grant is if your revenue numbers every year is over 100,000. Then you would divide that 5 years for 5 years by 20 every time you are meeting that criterion. Okay, so this is an example when they already give you the money in good faith, but they can claw it back depending on if you meet criterion. Okay. The next one is conditions have been met, but the grant's not received. So you're going to record it as grant receivable. So if you've worked through your case facts analysis criterion based on the grant conditions that are given, whether or not you receive that money, that's going to depend on. So you've already been entitled, or you have permission to record this on your financial statements. You just can't recognize it into your P&L yet until you receive it, right? Now, the last one is sometimes the government would give it to you as a loan with favorable interest. Anytime you see favorable interest, you can assuming you meet the grant conditions again, you have to use a discounted, or you have to discount the value of that loan based on the effective interest rate, or the EIR, and you would bring that into income. Okay, so whatever, like your subsequent measurement is as it's accreting up that discount, then you get to bring that into income. Okay, so this one is a little bit more complex. It's not very common, the government loan that has a favorable interest term. So just recognize the most common ones are the ones over here, specifically knowing from the category of income or whether or not it's to assets. So relatively straightforward when it comes to government assistance. I don't expect it to be very complicated. You should be very much jumping for joy if you see government assistance. The complexity is not very high, and it's relatively simple and straightforward to address. So this is one of those topics that I hope and wish to see if I were you in your shoes. So now, what happens if it were to be government assistance related to non-monetary? Okay, the first thing is if you get government assistance related to non-monetary, one thing just to pay attention to when it comes to there's a difference when it comes to IFRS or ASPE. So both of these criteria, there's no difference whether or not it's IFRS or ASPE, okay, in terms of the treatment. The difference comes from the non-monetary. And so for ASPE, it's always recorded at fair value, which will be given to you, right? And then if it's IFRS, you get the choice of doing it at fair value or at nominal value. So, not really, again, very common when it comes to non-monetary government assistance. Usually when people work with the government or apply for a loan application, it's usually monetary, right? Like you want money from the government to support the cause that you're working on or the business or whatever, and it's usually going to come in financial forms, okay? Okay, so very quickly, I just want to make sure that you recognize there are additional notes that have where I've pulled out the concepts of how to quickly use it. I'm not going to go through all of this stuff in extreme detail because you can definitely read this at your own time. But just to go through the slides here, grants are not recognized until there's reasonable assurance that you're going to get it. That's relatively straightforward. So the case is going to give you conditions of an agreement for that grant, and whether or not those conditions are met, that's when you get permission to record it on your financial statements. Okay, and once you meet those conditions, the issue really is when you receive the cash, and that's going to decide how you recognize it. Okay, either as an asset, as a receivable, or as cash, right? So in the recognition and profit or loss, you have two choices. The choices of first, it has to be a systematic basis over the expenses related to it. So going back to if it's an asset, you're going to match the systematic basis of amortization or depreciation. If it's related to expenses that has already happened, you can just recognize it right away. Alternatively, you could net it against the expense. The main change is really a presentation issue, and that's going to depend on certain needs of the users, and that's what you have to be very careful of when you are reading the cases. Now, if it's grant related to assets, so it's recognized deferred income, P&L, systematic basis. So this one we've already covered, grant related to income, okay? Repayments of grant. So once you accounted for changes in estimates, so grants related to income, the repayment is applied first against any unamortized deferred credit recognized related to the grant. Any excess when no deferred credit exists is recognized immediately. So, if your criterion is no longer met, so remember, just because you meet it in 1 year doesn't mean you meet it in years 2, 3, and 4. You've got certain conditions that need to be met. So sometimes, most of the time, some common grants that governments would give is based on your revenue. Are you meeting this certain revenue figure? Well, each year you could be meeting it, and let's say by year 3 you're not meeting it. That gives them a condition or capability to call you on that grant and get it back, claw it back, right? And so if they claw it back, you've got to see what your remaining value you have on the balance sheet, and that's when you will have to clear it out, right? Either by crediting the receivable or debiting the deferred liability, depending on how it is initially recognized, okay? So that's when you go back to the balance sheet to find how much is sitting there after the various years of activities, and then you clear it out, okay? Grant related to asset, the repayment is recognized by increasing the carrying amount of the asset or by reducing the deferred income balance by the amount repayable. Again, remember, you have the option of recognizing it over income over a period of time by amortizing it or applying it to the capital assets. So this is really where whatever that policy choice you initially did, you just have to reverse it, okay? So now when it comes to the accounting issues and analysis part, first identify there's a government grant, right? Describe that there's an issue using case information and what that issue is by describing how that assistance is being used, either applied to expenses or capital expenses, okay? Once you've described what that is and what the issue is, right, you will describe here, government grant, if it's related to current expenses and revenue, you're going to go through and describe those options, okay? Like how they can record it, either net expense or or as other income. But if it's on the other ones, let's say capital assets, you're either going to deduct it against the capital asset, or you're going to defer it and amortize it as a liability. So these are the options you need to present. After that, now what if the government grant that has not been received is to be recognized in the current period? So if you haven't received it, you still have to work through the criterion to determine if you can recognize it as a receivable, for example. And then you've got to discuss, well, once that step has been made, how are you going to record it from when you actually receive the amount, okay? That's where, you've got to recognize which side you're working with, whether or not it's balance sheet, asset, or liability. And then the government grant that has become repayable, it's counted as a change of accounting estimate, or really apply it prospectively. And if if you're repaying it, is applied first against any unamortized deferred credit relating to the grant. Any repayment in excess of the deferred credit when no credit exists is immediately in P&L. This is very unlikely. Like, there's no way where if they gave you 150 grant, you've already consumed 20. Let's say it's 25,000 per year. You've already consumed 50,000, so you have 100,000. They would normally ask you to pay back the 100,000 because you've met the criterion years prior, unless there's some conditions in the grant that says you must repay the amount in full. Then that 50,000, as an example, would come out as an expense. Because, well, if you think of it, it makes sense where in the past you've taken 25,000 each year as a benefit for meeting the grant criterion, and then now you just have to reverse it. So your retained earnings stay generally the same. So kind of a lot of common sense applies when it comes to these grants. And ultimately, if they paid you a grant and you didn't meet the criterion, you've got to pay them back. Whether or not it's in full, that's what your analysis needs to cover, okay? So let's work through a couple of examples here. And so let's see from here, government help established a production facility at a cost of $30 million. The cost of the land was $6 million, and the cost of the facility was $24 million. So land was $6 million, facility was $24 million. The government help received a non-refundable, so this is very important to recognize in the case facts, government grant in the amount of $10 million to help finance the acquisition of the land and the facility. The grant requires government help to satisfy specified conditions for a period of 10 years. In this example, it's lightly vague, but again, once I see government assistance, my first trigger and alert I have to think about is what is the criterion I need to have to meet, or what are the conditions that I need to meet, and I'm looking for those, okay? Paying very much attention to what they are and almost writing them down, okay? Because that's going to be in my analysis anyways, in my outline. The production facility is being depreciated on a straight line basis over its estimated useful life of 40 years and has an estimated residual value of 0. So based on this situation, what would you guys, so I'll give you guys about 1 to 2 minutes to solve this, but what would you guys do in terms of the treatment of this situation here? Okay? So I'll give you guys a couple of minutes. And if you have your response, type it in the chat. Okay, so there's a pretty good question here. Sai asks, can a government grant against income be deferred if the future conditions are attached to it are not met? So that's a very open-ended question because it all depends on the conditions, right? Those conditions and how that grant is given or what that grant is for. The grant could be, let's kind of to build on this example. There's a $10 million grant that's provided. And you can see this is to help finance the acquisition of the land and the facility. Maybe there's another thing that they've asked that, and to also pay for initial hiring of labor. Okay, and they told us the labor cost is $100,000. So, in those circumstances, what we're going to work through in this example, we'll kind of see what I mean by it depends on how they describe the conditions. So if the conditions are given to you and there is a income component related to, like a current income component, like for example, salaries or something that is not as long-term as a fixed asset, so it's a combination of income and asset, then that income portion could potentially be recognized early, depending on if that criterion is met, that condition is met. Okay, so it's almost similar to how you guys are used to analyzing and solving for revenue, the measurement of revenue, okay? Based on when certain obligations are being met. So in IFRS 15, for example, the second step is identify performance obligations. Conditions are the same thing, right? Those are performance obligations or requirements you need to meet in the grant. And if the grant has specific performance obligation conditions, then that's what you need to state. And there is a revenue in depth, and I definitely will go through that in detail when we get there, right? So it's important to learn to identify the performance obligation. So let's kind of use this. This one, the Excel. I'm just showing you an Excel here just to show some math here. So let's say build land is 6, and then building facility 24. So the first thing is the grant given. Let me just move this down a little bit. Grant is 10 million. Okay. So the grant is given to help finance the acquisition of the land and the facility. So this is really important to figure out. Now, first of all, we can recognize there are two choices. We have two choices of either netting it against the facility and the land or recognizing it into income over a systematic period of time. This is applied to fixed assets, right? And if we go back to the initial notes that we have, if it's fixed assets, it can be either deferred income and amortized with depreciation or deducted against the asset's carrying value. So we have two options. So that's the first thing that we want to make sure you do your discussion. And I'm not going to do that discussion yet on this example. We will do some discussions later. Written responses, sorry. So the first thing is obviously if we're doing it in accordance to how we're going about it, the first thing is to recognize, okay, well, there's this weighting that we've got to recognize. Okay, so let me just lock this in. Okay, whoops, something's not right. This divided by this. So 20% of that is related to the land, and then the other 80% is related to the facility, which is quite interesting to see and know. Okay. And so if we go through that, what's important to see is, so you have a choice. Okay, so let's say if choice is deducted against the carrying amount of assets, you're going to take the 6 minus this times this times this. do it this way. This times this. This minus oh man, a little bit rusty today, not sure. But okay, so here is going to land net book value or carrying value. Okay, facility. Going to apply the same thing. So I'm just going to copy this formula down, just move some of the numbers. Okay. Wait, something's not right. Sorry guys, it's this times 20%, and then this minus this. Okay, then it's this times this. Okay, it's supposed to be 2 million. Okay, it's a little bit rusty today, but anyway. Okay, so you see the 10 million is applied to 20% related to so the facilities net book value is 16,000. Okay, now I know what's wrong. Okay, just a little long day today, guys. Sorry. So here we have 4 million, which initially was 6 million minus 4. Okay, is 2 million. Okay, so that's how much the grant was applied to the land, and then this much of the loan was applied to okay. Okay, so now you can sort of see how the loan grant was applied. And then here's the net book value of the land and the facility. So relatively straightforward. So this is if you had the choice of doing it against the carrying amount of the asset. The next is choice of treatment when grant is deferred and amortized. So since we're accountants, we've got to do the journal entries, debit cash, 10 million. Credit land, credit facility for this. Okay, so now what if we're doing deferred and amortized? So this one's going to be a little bit tricky, but what's really important to see is now going back to the case, the production facility is depreciated on a straight line basis over its useful life of 40 years and has an estimated residual value of 0. Okay, so I'm just going to make sure I point that out for you just so that we clarify something that's coming. Okay, so no different. Okay, the grant application is still going to be the same. So grant is still this. Now, the only thing that sounds a little bit contrary, but obviously makes sense, is this is over 40. This needs to be applied over 40 years, and you can make a discussion and be like, well, the land is not depreciated, so why am I netting that expense off of the land? And that could be a very logical argument. The only thing I'll just say is this is against this is based on how the handbook describes. Okay. So, facility, 40 years, 40, oops. Okay, whatever. Oops, sorry. So facility is 24,000, and this is divided by depreciation, which is 40. 600, and so income application is 8 million, and then this is divided by 40. So this is what you would bring into income. Okay, so land is 6 million. Grant application is 2 million. Depreciation is 0. Income is 0. Okay, so this impact on FS, assets are asset balance equals 30 minus the 10. And then impact on the FS, asset balance. Here, asset balance is same thing, so 30,000. But this one has a liability balance. I'll put initial. Subsequent measurement income effect. Facility divided by 40. Expense, depreciation expense. Subsequent measurement income effect. Depreciation, which is this minus this. 400. Okay, so you can see the treatment's the same, right? There shouldn't be any difference. Oops, let me just move my screen so you can see a little bit of it. Okay, so the treatment shouldn't be any different. Okay, that's why the policy choice is there. But there is a difference in terms of presentation, right? Like, what if you have specific covenants that are based on fixed assets and not counting liabilities? This is just, let's say it's based on return on assets. Well, you probably want to see, well, which one gives me a better number when it comes to that type of measure, when it comes to return on assets. If you have a smaller denominator, it's in your favor, right? If you have a larger one, then it's not. So that's just something for you to kind of pay attention to. This is where the stakeholders are the ones that are going, you have to be very aware of the stakeholders when it comes to deciding which policy choice to work with. So you can see there's no difference in the overall effect on the income statement. There shouldn't be, right? But the balance sheet, there could be potential ideas to be careful of. So Sai, you ask to defer and amortize the grant of the 2 million portion across 10 years. I'm not sure where 10 years came from. And I see what you're saying. Okay, so the grant requires government health to satisfy specified conditions for a period of 10 years. That's pretty fair and reasonable to make that argument. But I'm just going to say when it comes to ASPE, the grant portion, the deferred income relating to the portion of the grant is recognized in income or loss only if and when the land is written down for impairment or the land is derecognized. Okay, so this one makes things a little bit challenging or difficult, but for argument's sake, I would position it as, well, 10 years has already lapsed, and if you've already met that criterion, so after 10 years, this is very clear that you can recognize it. Okay, so normally if within the 10 years, maybe that land has become impaired by whatever land is worth 6 million, right, and it's been impaired to 4 million, then you can recognize the full 2 million right away within the years 0 to 10. So I'll just add in a comment here. Recognize on impairment. So within 10 years, recognize on impairment. Once 10 years lapses, can recognize in full. Okay? Once 10-year lapses with derecognition, so sale of the land, can recognize in full. Okay? So you can only recognize after the 10 years when it's been sold. Okay. So, if you never sell that land, just to make sure I'm clear, until you sell the land, you're holding on to that liability, this liability balance, because you're never depreciating it unless there's impairment. So actually, I shouldn't say within 10. Oh, actually, no, it doesn't really matter. So once 10 years lapses, and if there's ever any impairment, that's when you can. But other than that, you will only recognize or bring into income that gain when it happens. If you sell that land, once you remove that land off your balance sheet. So you have to recognize that liability as part of the land now. Okay, so sort of here's the high level slides for that, and you guys will be able to see the Excel. This Excel is not really complicated, so as you watch the video, you can go through that. So let's go through the next discussion, which is on this situation here. So Government Help Inc. incurred employee remuneration costs in the amount of $2.4 million for its annual reporting period ended June 30th, 2015. The government has provided a grant of $800,000 to help the Government Help Inc. pay its employee remuneration costs for this reporting year. The grant is paid quarterly and and Government Help has received the full amount by June 30th. So I'll give you guys a little bit of time. Whoops. So just pause that for a second. And so I'll give you guys a little bit of time to go through this. So just bear with me while I'm trying to move the screens. Okay, so example 2. I'm just going to set up the question while you guys are working through the answers. If you guys get the answers, please do type it in the chat. Okay, so this is relatively a straightforward example. Right on the case, it says you've already received it, okay? And we're reporting for the June 30th, 2015, the total remuneration costs, so P&L, income statement. Remuneration cost is 22400,123. Let me just fix this. Grant 800. Okay, so just sliding back a little bit to the earlier slides. So remember, our options or choices when it comes to related to income, separate as other income or netted against the related expense. So just to kind of demonstrate that, so choice 1. Choice 1. Employee remuneration costs equals this. Other income as this. Net income before tax is this. Second choice, so choice 2, is employee remuneration costs is this minus this. Net income before taxes equals this. Okay, so you can see overall no difference in the impact on the P&L. Again, relatively straightforward. The best one, if you ever get, is this one. The discussion is also really quick and straightforward. To be honest with you, my opinion is something like this, simple and straightforward. If you get financial reporting for CFE at least, on your third day, this is really quick to write and go through. And again, we're going to work through some more situations later tonight, just to curve it out all in detail. Okay. All right. So so similar example. Oh, there's the journal entries. I got to make sure I do my journal entries, but you have those here, which is debit cash for 800, credit grant income or other income. If you do it as a deduction or related expense, debit cash and credit against the employee remuneration expense. Okay. Yeah, Preet, excellent detail, always. Great job. Sai, yeah, excellent. Okay, so now I'm going to switch to this version here, and we're going to start doing some writing, so you can see sort of how the application of this works. Let me first expand the screen, so just bear with me. I'm going to lock this in because I keep moving it. Okay, so Entity A has received a payment of $5 million from the provincial government to reduce Entity A's labor costs as an incentive to set up production facilities in the province. The government assistance was received in advance on April 1st, 2015 is applicable to the salary costs that will be incurred by Entity A in the year ending June 30th, 2016. So how would we go about treating this item here? So now you guys can discuss this qualitatively, and I kind of want to see a little bit. This one's a little bit manageable when it comes to working with it, so let's see how that's applied. Let's see if this works. Okay. Okay, so let's kind of use some of our writing skills to apply this here. Okay, so situation one, Entity A has paid the government grant as an incentive. Received a government grant of $5 million from the provincial government as an incentive to set up production facilities in the province. The government assistance was received on April 1st. So the first thing is we can see, okay, I'm just going to start writing this down. The entity received for labor costs. So this is really important. So now I've just kind of pretty much copied from the case information. The issue is whether the income, the government should be recognized as other income or expenses. Okay. Okay, so let's pull open the handbook. Let's just for fun, since I have ASPE open, I'm going to solve it with ASPE. We're going to go to ASPE 30 section here, expenses for future periods. Okay, you see the italics. Just going to pull that. Okay, so the appropriate amounts shall be deferred and amortized as related expenses occur. Since the since the amount was received in advance, this cannot be recognized in FY 2015. As a result, this should be deferred and amortized. Currently, there are two options to record this as other income or net of expenses. When that happens, this policy choice or expenses or net of deduction in 2016 based on decision Okay, so there was no real information related to management, right? Like, or whoever, no stakeholders. So, I'm just kind of putting a placeholder in there so that you guys can sort of see also how that is, the choice once. So, you kind of are describing. What's really important is if you need more information, which you do, right? You don't know which one to actually choose. You're just saying, well, this is going to be brought into income or a deduction of expenses. But I will only know which is based on management choice. The problem with a lot of people is when they need more information, they actually just say more information is needed, but they don't actually describe what of that more information is needed. Okay, so I'm just going to put in here quotes. Note how more information is needed and is described. Specifically, what is needed. Okay, so here's a small little tactic to know how to handle when more information is needed. Okay, so let me just fix the formatting of the font color so you can see. Okay, impact on FS, debit cash, 5 million, credit deferred grant liability, 5. Okay, so now let's work through the next one. Okay, so I've put down here specifically the sections that you would use if it was IAS or ASPE. Okay, so next one maybe we'll just do IAS for fun. Okay, so Entity B has received a government assistance towards the construction of a production facility. Entity B plans to defer the government assistance and to amortize the assistance to income over the term of the debt incurred to finance the facility as a reduction in interest expense. Because the government assistance is in substance a reduction in the cost of financing the facility. So I'll give you guys a little bit of time to read that through while I set up the answer. Okay, so here, Entity B has received assistance towards the construction of a production facility where there are plans to defer the government assistance and amortize over income over the term of the debt as reduction in interest expense The issue is whether or not is acceptable for application. Okay. So analysis. So let's go to IAS. Okay, so we're going to go to IAS, IAS 20, and so presentation of grants related to grants. Okay, so I do need to expand this a little bit, so bear with me, guys. Actually, let me do it this way. Okay, so government grants relate to okay, so let's pull the relevant section. So the bold is here. There's also okay, so there's the guidance. Now, I want you to just pay attention and note here. So you see how the guidance is here. The actual relevant section to what we're working with is one method is to deferred income that is recognized over a systematic basis over the useful life of the asset. Okay, or here's the other one. The other method is to deduct the grant and calculating the carrying amount of the asset. The grant is recognized in P&L over the life of the depreciable asset as a reduced depreciation expense, similar to our first example that we worked on. So, Entity B's approach to applying the government assistance is not appropriate as per IFRS or as per IAS 20 because as per above it must be presented as deferred income over it must be presented net of expenses, depreciation expense, or the carrying or net carrying value of the asset of the production facility, applying it as a reduction of debt. Interest expense is not appropriate or applicable. Okay, so, oops. Just gonna copy this answer because I'm a little bit trying to be efficient. As a reduction of depreciation expense, so net, or a deduction of the cost of building the facility. There is a policy choice, but this is based on decision from management. Okay, so these again small scenarios can't really provide the overall detail. I'm just taking snippets of it so that you can see. Okay, Impact on FS, debit cash. Actually, currently this has not been received, but when it is, the choice will be to record cash to increase cash and liability, where it is amortized over the useful life net against depreciation, or increase cash and decrease the asset value. Okay. So next situation, the accounting treatment. So just going through that, the accounting treatment is not acceptable because the government assistance relates to the construction of the production facility. It's based on what the conditions are, right, of the grant. It's either deducted from the cost of the facility or and with amortized calculation on the net, or is deferred and amortized to profit and loss on the same facility and is amortized. You know, the other part that you can talk about is the amortization. So depreciation, sorry. So the depreciation. Actually, no, that is given. If applied net of carrying value, the depreciation would be lower since it is taking into effect the amount of the grant that is provided. The amortization of the grant would apply to the same useful life of the building over a systematic period of time. Okay. So situation number 3. Entity C has received a forgivable loan from the government that will be forgiven in 5 years on condition that the enterprise meets employment and environmental standards specified in the loan agreement for a period of 5 years. So again, this one will solve following ASPE. Okay. Let me just write this down. Issue is when the loan is received, how should the loan be recognized? Okay, so if we go into ASPE, $3,800, here, forgivable loans. Okay, so I think you guys can see I just want to show you how I go about solving my financial reporting. It's relatively simple and straightforward. I think people take too long trying to figure out all these approaches, but first the key is to get all the information down, right? Like you can see it's relatively quick in this. So when an enterprise becomes entitled to a forgivable loan, which is the case, it shall be accounted for in the same manner as a grant. So what does the grant say, right? The grant, since the loan relates to to entity C meeting employment and environmental standards, which is applied for a period of 5 years. As a result, this would follow the grant recognition criterion. So let's go there. Scroll up, paragraph 20. government assistance relates to expenses in the future period, the appropriate amount should be deferred and amortized to income as related expenses occurred. So, so this should be recognized. Therefore, since this relates to expenses over a period of 5 years, this should initially be recognized as a liability and recognized over recognized in let me use the word, and deferred and amortized into income over a period of 5 years. There presents a policy choice of either recognizing it as other income or netted against the expense, expenses, the relevant expenses. Now, so this is a forgivable loan. This is what is really important to understand. Specified in the loan, which is for 5 years, that means if I meet the criterion over these 5 years, it'll be forgiven. So if it is forgiven, I don't have to repay it. So now I have to talk about subsequent measurements. Okay, so this includes initial recognition and measurement, subsequent measurement. Now, the loan has a possibility to be forgiven. However, if conditions are not met, so what I want you to see is, first, there's no case facts given to say whether or not this is forgivable or not, but because the fact that this says it's forgivable, okay, this is supposed to trigger you to go, so this is not asked of you, okay, but maybe, it depends how you interpret it, but if the government gives me a loan, then I don't have to talk about, well, I'll still talk about this next part that I'm going to talk about. But so it's a forgivable loan. That's going to trigger me to talk about, well, unless the loan is repaid because the conditions are not met. Okay, so now I've added something in here because the loan is forgivable. If it's not met, you have to repay it. So we've got to talk about repayment conditions. So however, if conditions are not met, this loan may need, will likely need to be repaid. Either, so it's unclear whether this loan is to be repaid in full or partial. Okay, so that's not clear. So let's go through the guidance here. 29 down here. The liability to repay shall be accounted for in which the repayment exists. Okay. Since it is unclear that this loan must be repaid and whether or not those conditions in the future are withheld or known, the amount is deferred and amortized, described earlier, except for when the repayment conditions occur. It is unclear. Okay, so if the amount is to be fully repaid, the amounts previously deducted in the net income shall be fully reversed and expensed. Okay, so recommendation, I'm just going to copy the recommendation. policy choice is required for, actually let me just copy this. Further information is required on repayment terms if conditions in the future are no longer met. So I'm just going to copy this again for you. Otherwise, forgivable loan is to be treated like a grant, and the option is to be impact on the financial statements. Once loan is received, increase in cash and debt, assuming conditions are met, irrespective of policy choice, income will increase 1/5 of the loan amount if loan is to be repaid when conditions are not met. Remove carrying balance of loan. Cash decreases, and possible impact of possible expenses related to amount of grant previously recognized as income. Okay? All right, so the last example Okay, so here a forgivable loan is accounted for in the same manner as a grant. The sections are here, and the grant relates to the employment and environment protection expenses over the 5 years, so you can net it against protection expenses. When the government assistance relates to future accounting periods, the appropriate amounts are deferred and amortized to the P&L, and a liability to repay the government assistance is recognized only in the period in which the conditions arise. Okay, so pretty much the same, but I'm just sort of showing you guys how to address this response under that. Now, one important thing to note is you can see from the example, it's just 3 lines, but this analysis takes quite a bit of time and quite a bit of, diligence and sufficiency to work with. And, that's what is what's shocking sometimes is when I review some of my initial mentees who haven't been trained by me yet, some of their content is actually less than the case facts, and which is fully understandable. It depends on which education system they've been trained under, and under that, right? Like sometimes you're just looking for the answer. The answer is a little bit straightforward, right? But you've got to be able to describe and demonstrate to the markers how you've come up to this process, and that takes quite a bit of work. Okay. All right, so let's work through the last situation. Situation 4, Entity D owns a professional sports team that will receive a payment of $1 million from the government pursuant to an agreement that the government will subsidize a stated percentage of the Entity D's loss from operations. Entity D has not recognized the benefit of the government assistance that has to be received because it will not be received until after the provision of the audited financial statements of Entity D to government cover the grant. And because NTD's objective is to maximize its reporting loss due to upcoming labor negotiations with the Sports Players Union. Okay, so some things to kind of recognize. Now I will actually copy this example down straight from here. There's a reason why I want to copy it down, because I want to show you how I would have highlighted something like this. Okay, so most people will look at it and be like, oh, this is a grant issue. I can see there's a grant issue related to 1 million. I'm going to underline that. Okay, so has not recognized this benefit that is received because it will not be received until the provision of the audit. So and because this is reported loss due to the upcoming, so there's some bias here actually. Okay, and again, people when they're reading their cases, they're not very careful. And this is a smaller case just to give you an example of just a paragraph where that trigger of that information is there. That, here's that issue, okay? Aside from that issue, now people somehow forget to read or don't read the rest of this. And, they think that, oh, once I've already pulled out the AO, I can ignore anything after that. That's false, okay? The goal of when you're writing these cases is to know how well you're able to pull out the case information. And with my mentees, we go through a very detailed debrief process to know how to use the case information very, very well, okay? And, it's a very structured work, almost like a worksheet, workbook process to debrief your cases, and this is really key, okay? Knowing how to pull the case information and how to use what's there, okay? So that's just there for you. So I'll give you guys a little bit, like 2 minutes to sort of read the question here. Before I sort of set up the response to solve it, okay? Okay, so let's kind of take this. Owns and operates professional fee. The issue is how should the is whether entity D treated the treated the government assistance appropriately by not recording it. Okay, so let's solve this with should have asked you guys for votes, but I'll do just for the sake of because the last one was IFRS, ASPE. I'll do this one under IFRS. So IFRS going to here, government grants, compensation for expenses. Okay, so this. So let's kind of read this first. Okay, the government grant becomes receivable as compensation for expenses already incurred, or for the purpose of giving immediate financial support to the entity with no related cost shall be recognized in the period in which it becomes receivable. So this is very important. Okay, there's a specific section that's describing the details of what you need to do. Yeah, pretty excellent journal entries. I'm going to fully steal that when I write my response. So in terms of the analysis, entity D incurred from the government pursuant to an agreement that the government will subsidize a stated percentage of the entity's loss from operations. Incurred a loss from operations in the current year. The decision, based on IAS 2020, the treatment to not record the assistance is incorrect, and also should not be based on the reasoning that to maximize its reported loss due to upcoming labor negotiations. Although the grant was not yet received, the conditions for receiving have been met and was specifically applied for current year operational losses. Therefore, this should be recognized as a receivable. Should be recognized as a receivable. Management is likely to disagree, for their intentions is to maximize losses for upcoming union negotiations. However, this is not correct, and if that is the case, entity D could jeopardize their application for receiving the grant. Okay. Impact on FS. Debit AR government grant 1 2 3 1 2 3. Credit other income, or since this relates to expenses, there is a policy choice. So we'll go back to IAS, so paragraph. Oops. Okay, so just copying this down. Management will need to decide to recognize against expenses. However, or recognize as other income. However, since this is based on entities D's overall losses, it's suggested that it be applied as other income. Okay, so is other income 1 million. Okay, so a couple of things to recognize. So you see how I've taken the case information here, described it using what the issue is, taken the handbook guidance, and then also applied the case information and discussed against some of the stuff that I've highlighted here in yellow. Okay, so it just needs to, other than the provision related to the audited financial statements, it appears to be met. Okay, so you know, I could put in here, there's a possibility. Note a possibility that after the financial statements are audited, the grant conditions may no longer be met, but it is currently assuming that a loss exists after audited FS. Okay. So here, grant shall compensate. So since related expenses, since it's so here, I've already made a suggestion. This one, there's no real choice because, you know, it doesn't make sense if it's related to a whole bunch of other expenses. It's hard to say how you're going to assign it. Also, it's not very efficient and effective because to the other expenses, since it's very general and applies to the overall entity. Okay, and then also note that there's a possibility that after the financial statements are audited, the grant may no longer be met, but is currently assuming that a loss exists after FS. Therefore, here's the recommendation: FS, impact, and so on and so forth. Okay. Actually, oh, Preet, yeah, when I was highlighting, sorry, when I was highlighting, I saw you wrote grant liability is actually to income. Okay, because you've got to recognize it in the period that makes sense. I actually, you know, from all of my experience, I've never really seen a debit AR and a credit liability AP, to be honest with you. Okay, so Chu, are we supposed to assume that entity incurred a loss? You're not supposed to anything. You just need to state it. Okay, so I've written that also down, and then based on case facts, did not state that they incurred a loss. The assumption is they have, because of the comment that, you know, I've written it already, but here that they will receive. Okay. So I'm just going to highlight that for you to see in this color, that will receive. So that's assuming that they've already met it. Okay. But are we supposed to jump to the conclusion that it has incurred a loss? Well, based on preliminary information, they have appears to have met that requirement for the grant, but until then, we don't know. Okay, until the audited financial statements, which is the comment that I addressed here. So here's where, here's example of how to handle future unknowns or uncertainties. Explain what is needed and what is uncertain. Contingent. Okay, so you know, this is some special secret advanced case writing techniques. It's very subtle and small, but quite effective after a good amount of experience and time. And, you know, like learning from an experienced individual like myself, not trying to brag, is what you want to be able to do. And that's what your mentor is here to help you with, right? You know, the alternative path is you can, of course, do this on your own. Nothing's stopping you from that. But your chances of passing the increase when you're working with somebody who's experienced, can save you a lot of time, point you in the right direction, and also give you small little tips and tactics to handle these things. And that's really what the mentorship is for. And for you guys currently watching the webinar, that's what when I demonstrate the case writing responses, go through. And so again, not much of a case writing class or session, but where there's an opportunity, I definitely will show you guys, I guess, secrets where there can. Okay, so that pretty much wraps it up for tonight. It is a relatively simple, straightforward issue. If you recognize first to go through, let me just open up the slides. If you just go through and recognize if it's income or asset, and then recognize as a policy choice, so you've got to discuss this. Lastly, once you have met those conditions for the grant, you've got to know when it's been received. And once you know how it's going to be received and the situation and the context, you've got to make sure you discuss and address that. I've already shown you guys how to apply the handbook using like working on the question live and on the spot. So hopefully you guys found that very useful. And once again, I really appreciate all of you who are tuning into this live because it is pretty late in the evening. And if there's nothing else, please do leave a positive review if you like this, and hopefully I get a chance to see you guys again into my next webinars. That's it, and have a good night, guys. Thank you.